Imagine you are trading in the stock market. You press the buy button. You think you bought it at the right price. But in that same fraction of a second, someone else bought that same stock before you. Your order was filled at a slightly higher price. You didn't even realize it. And this is where the real story of Flash Boys begins. This book is not the story of an ordinary investor. This book exposes that hidden world where money is not made through hard work but through microseconds. Michael Lewis takes us into the market, which we consider a free and fair market. But from the inside, that market has become a high-speed battlefield. The story begins with a man named Brad Katsuyama. Brad was no ordinary trader. He worked at the Royal Bank of Canada. His job was to handle the buying-selling of millions of shares for large clients. In the beginning, Brad thought the market was working perfectly, but gradually he started seeing something strange. Whenever he placed an order to buy a stock, before the order was completed, the price would go up. Always. Again and again. Constantly. At first, Brad thought, maybe the market is volatile. Maybe it's a coincidence. But a trader doesn't operate on coincidence. He looked at the data, the time of every trade, the response time of every exchange. And then he saw a truth. Some people were able to see the market before he could. The most dangerous concept of the book starts here. High-frequency trading, HFT. HFT firms were traders who were not human but machines. Super-fast computers, algorithms, which before a human could click, could sense that click. When Brad sent an order to the New York Stock Exchange, his order reached different exchanges with slight delays, and HFT firms had turned this delay into a weapon. As soon as Brad's order reached the first exchange, the HFT algorithm would understand a big buyer has arrived. Then what would happen? The HFT machine would reach the other exchanges. Before Brad, it would buy those same shares and then sell those same shares to Brad at a slightly higher price. This wasn't theft. It wasn't even illegal. But it wasn't fair either. Michael Lewis says a very deep thing here. The market is no longer a game of skills. The market has now become a game of speed. Whoever had the fastest cable, the fastest server, the computer closest to the exchange was winning. And this was the reason why, inside Wall Street, data centers were spending crores for just one thing, nanoseconds. For Brad Katsuyama, it wasn't just about the money. It was a question of trust. Clients thought that the market was working for them. But in reality, the market had been designed against them. Brad did not resign. He decided to fight. He spoke to technologists. He met ex-HFT experts. He met physicists. And for the first time, he understood that the real power of the market was not inside the exchange but hidden in fiber-optic cables. There was a race to lay a straight cable from Chicago to New Jersey. The one who reached first could see the future. Flash Boys shows us how modern markets had silently become unfair. No noise. No scam. Just code. And this is the point where Brad gets an idea. If speed is an unfair advantage, why not make the market slow? From here, the idea was born for an exchange that rewards fairness, not speed. But this idea was dangerous for Wall Street, because if the truth came out, a game of billions of dollars would be exposed. And from here, the story starts becoming even deeper, even more dangerous. Brad Katsuyama now understood that the biggest currency in the market is not money, but speed. The Battle of Wall Street was no longer between traders, it was a battle of machines versus machines. High-frequency trading firms did not predict the market, they reacted to the market. Before a human could understand anything, Michael Lewis explains that these firms installed their servers right next to the exchange. This is called county location. Whoever's server was 1 foot closer to the exchange could see the data a few microseconds earlier. And microseconds meant profit. It took time for Brad to understand that his order did not go to one place. In the US, there wasn't just one, but dozens of exchanges. An order reached one exchange first, then the rest. And this gap was the playground for HFT firms. A signal received from one exchange, the algorithm would race to the other exchanges, bought shares, pushed the price up, and gave those same shares to Brad at a higher price. All of this happened in less than a second. So fast that the human brain cannot even process it. Brad asked a question, "Is this really legal?" The answer was yes, because the law was not even made for this kind of speed. The rule book of the market was written for humans, not for machines. Michael Lewis explains here that even regulators could not understand this race because they saw volume was increasing, liquidity was increasing, but they couldn't see that the liquidity was fake. As soon as the market moved, HFT firms would vanish. Brad was no longer alone. He found some people who were once themselves part of the HFT world. One of them was an expert from Ronin Capital, who said plainly, "The market is rigged, everyone just doesn't know it yet." From here, Brad started breaking down the problem on a technical level. He measured the speed, looked at the length of the cables, understood the path of the signals, and a shocking truth came out. A straight cable had been laid from New York to Chicago just so that futures market data could be received a few microseconds earlier. Millions of dollars were spent on this cable just to save time. At this point, Michael Lewis says, Wall Street was no longer playing economics, it was playing physics. It became clear to Brad that if the market is to be saved, speed must be neutralized. Fairness is not possible as long as the fastest keeps winning. And from here, a radical idea is born. What if every order is given a slight delay? What if every trader gets the same time? No fast lane? No secret cable? This idea was dangerous for Wall Street because it could destroy the entire HFT business model. And this was the reason that as soon as this thought came out, silent resistance against Brad began. Banks became uncomfortable. Exchanges became nervous. HFT firms became hostile. Because for the first time, someone was challenging the system from its roots. Flash Boys shows us that the problem was not ignorance. The problem was that the system was working for those who would never complain. And those who were losing didn't even know why they were losing. Brad Katsuyama was no longer just understanding the problem, he was building a solution. The question before him was simple. If speed is an unfair advantage, how to make the market where speed becomes useless? From here came the idea of IEX Investors Exchange. IEX was not going to be an ordinary exchange. This exchange was being built not for profits but for trust. Brad and his team thought of a very simple but powerful thing. Give every order a small delay. This delay was 350 microseconds. So small that a human wouldn't even notice, but large enough that the entire advantage of HFT algorithms would vanish. This delay was named the speed bump. This speed bump inside the exchange was created using a coiled fiber-optic cable. The cable was looped around so that the signal had to travel the same extra distance. Meaning, no matter how fast someone is, every order in IEX will reach at the same time. This idea was a shock for Wall Street because for the first time, an exchange was being built slow on purpose. For HFT firms, this was a nightmare. Their entire business rested on speed. Banks were confused. Some traders were happy. Institutional investors felt for the first time, maybe the market is for us too. Michael Lewis explains that during the launch of IEX, Brad received both support and resistance. Some big investors, like mutual funds and pension funds, came with IEX because they were finally getting fair execution. But exchanges and HFT firms considered IEX an outsider. It was a threat to them. Rumors spread in Wall Street. IEX is anti-liquidity. IEX will slow down the market. IEX is against innovation. But the data said something else. Brad showed the proof. Trades on IEX were more stable. Slippage was less. Prices were more honest. Michael Lewis explains here that the real fight was not about technology. It was a fight of philosophy. On one side were the people who wanted to make the market a speed race. On the other side were those who wanted to make the market a fair playground. The biggest controversy happened when IEX applied to the SEC to become an official exchange. A debate started inside the SEC as well. Is a speed bump legal? Is slowing down an exchange market manipulation? The HFT lobby applied full pressure so that IEX wouldn't get approval. Because if IEX was approved, it would prove that the market until now was unfair. Flash Boys calls this moment the turning point. This wasn't just Brad's fight. This was a fight for ordinary investors who considered the market to be fair. Brad knew if IEX failed, the message would be that Wall Street will never change. And if IEX won, it would prove that the system can be challenged. IEX was no longer just an idea for an exchange. It had become a direct challenge to the power structure of Wall Street. The discussion inside the SEC was not technical, the discussion had become political. The question was not whether IEX works or not. The question was, if IEX is right, then what are the other exchanges doing wrong? Traditional exchanges called themselves neutral marketplaces, but the truth was that they were earning money directly from HFT firms. County location fees, special data feeds, faster access. Michael Lewis says clearly, exchanges were no longer referees. They had become part of the game themselves. The IEX speed bump raised a big question on this entire business model. If fairness is possible, then why the need to sell speed? HFT firms gave the argument. We provide liquidity. We narrow spreads. We make the market efficient. But Brad's data showed something else. When the market is stable, HFT firms are visible. But as soon as volatility comes, they vanish. Meaning, liquidity exists only as long as there is no risk. Michael Lewis tells a hard truth here. During a market crash, HFT firms do not protect. They protect themselves. In the SEC hearings, accusations were made against IEX that it is against innovation, that it manipulates the market. Brad said just one thing: we are not slowing the market, we are making the market equal. The speed bump was for everyone. No secret advantage, no hidden lane. This very thing was the most dangerous for some people. Large banks were playing a double game, publicly talking about fairness, privately earning from HFT. Flash Boys shows that in Wall Street, ethics are optional, profit is mandatory. Narrative control started in the media too. Some outlets called IEX a hero, some called it a villain. But the ground reality was changing. Big investors, pension funds, mutual funds, started trading on IEX because they could see the difference. Better prices, less slippage, more transparency. For Brad, this was a moral victory. But the fight was not over yet. The final decision of the SEC was going to decide the future of the entire market. If IEX was rejected, the message would be clear: speed wins, fairness loses. If IEX was approved, it would be officially admitted for the first time that there was a problem in the market. Flash Boys clarifies here, this fight was not about the law, it was a fight for the truth. And the truth is often the most uncomfortable. The SEC's decision had arrived. IEX received approval to become an official exchange. This was not just an approval. It was a huge signal in the history of Wall Street. For the first time, regulators had indirectly admitted that speed-based unfairness exists in the market. Brad Katsuyama had won. But this victory was not going to remain quiet. HFT firms were outraged. Traditional exchanges became uneasy. Because now the question had been raised, if IEX is right, then what are the other exchanges selling? Michael Lewis explains that after the approval, scrutiny on IEX increased further. Every trade was watched. Questions on every delay. Critics said, IEX is dividing the market. IEX will reduce liquidity. IEX will stop innovation. But the numbers did not support these claims. Institutional investors were feeling more comfortable on IEX. They were getting price improvement. Front-running was decreasing. Flash Boys says an important thing. At this point, a fair market doesn't mean everyone profits. A fair market means the advantage of cheating is eliminated. HFT firms suffered losses. And for those whose business relied on an unfair advantage, anger was inevitable. Michael Lewis also shows that as soon as Flash Boys was published, public awareness changed. Things that were previously called technical now became an ethical question. Investors started asking, what is happening with our trades? Why do we always get the worst price? This book is not just the story of IEX. It is the story of the breaking of ignorance. Brad did not change the market, but he changed the perspective of looking at the market. Now no one could ignore speed by calling it neutral. Flash Boys gives us a lesson here. The market does not become fair on its own. Fairness has to be designed. And those people who are benefiting from the system never want change. Brad Katsuyama did not want to be a hero. He just wanted that his client gets the same price they see. Such a simple demand became a revolution. In Wall Street, IEX had received approval. Brad Katsuyama's fight had technically won. But the story of Flash Boys does not end here. Michael Lewis says clearly, this book was not written to demonize HFT. This book was written to show that when technology gets ahead of ethics, the market silently becomes unfair. High-frequency trading was not illegal, but it was invisible. And invisibility itself was the biggest threat. Flash Boys proves that in modern markets, the most dangerous thing is complexity. When the system becomes so complicated that an ordinary investor cannot understand it, then fairness vanishes on its own. Michael Lewis explains that after Flash Boys was published, pressure on regulators increased. Exchanges had to show transparency. Data feeds, order routing, and execution quality started being watched. The market didn't change completely, but now no one could say that everything is fine. Brad Katsuyama showed Wall Street a mirror, and this is the reason that some people call him a hero and some call him a troublemaker. Flash Boys also teaches us that incentives drive the market. If the incentive is speed, then speed will win. If the incentive is fairness, then the design will have to change. IEX was an example. Proof that the system can be built in a different way. Michael Lewis at the end leaves an uncomfortable question. If something this big can remain hidden for years in the market, then what else is still hidden? Flash Boys is not an investment guide. It is a warning. Warning that blind trust is dangerous. Warning that technology is not neutral. Warning that fairness does not come on its own. The market becomes exactly what we allow, and this is the biggest truth of Flash Boys. The biggest irony of Flash Boys is that the retail investor knew the least and suffered the most loss. The common investor thought his broker was finding the best price for him. His order was going into the market in a neutral way. But Michael Lewis explains the broker's incentive was different. The broker got money from payment for order flow, meaning which exchange your order goes to was decided not by fairness but by commission. The orders of retail investors were the easiest targets for HFT firms because they were predictable, they were small, and they were unaware. Flash Boys makes it clear the retail investor cannot feel the cheating because the loss seems very small. But small losses of crores of investors become a big profit. The marketplace psychology here. You think, what difference does 1 or 2 cents make? But this very difference is the foundation of the HFT model. Michael Lewis explains that after Flash Boys, some brokers changed their order routing practices because now questions were being asked. But the system didn't change completely because the retail investor is still afraid of complexity. The lesson of Flash Boys is, if you don't understand the system can work against you. Brad Katsuyama's work was not direct for the retail investor, but its impact was felt by every investor. IEX showed that fairness is technically possible. The problem is intention. Michael Lewis writes a very sharp line here. Markets are not broken by bad people, they are broken by good people who stop asking questions. Flash Boys teaches the retail investor just one thing: do not have blind trust. Understand how the order goes, how the price is formed, and who benefits from speed. After Flash Boys, the biggest question was not whether HFT is good or bad. The biggest question was, who is controlling the market? Technology had become so fast that regulation was left behind. Rules were made for humans, while machines were running the market. Michael Lewis explains that the biggest weakness of regulators was not speed but understanding. When the regulator himself cannot understand how an order travels, how will he enforce fairness? After the publication of Flash Boys, pressure on the SEC and exchanges increased. The demand for transparency grew. Debates on market structure started. But the system of Wall Street does not change overnight. Exchanges still sell data. Speed is still sold. The only difference is that now all this is no longer completely invisible. IEX had provided a blueprint. For the future, don't make the market fast, make it equal. Michael Lewis says a critical thing here. Technology itself is neutral, but with what incentive it has been designed, decides whether it will bring fairness or exploitation. In the future market, three things became clear. First, speed advantage will always be questioned. Second, investors will now ask more questions. Third, there will be public pressure on regulators so that they don't hide behind complexity. Flash Boys does not claim that the market has improved. It just shows that improvement is possible. Brad Katsuyama did not win the market. He challenged the market. And this very challenge became the beginning of future reforms. The most uncomfortable truth of Flash Boys is not technology. The most uncomfortable truth is human behavior. Michael Lewis shows again and again that in Wall Street, people are not bad, but incentives are bad. A trader will do exactly what gets him a reward. An exchange will sell exactly what gets it revenue. A bank will allow exactly what increases its profit. And this logic gradually made the market unfair. High-frequency traders did not think that they were hurting investors. They only thought, if I don't do it, someone else will. This is the culture of Wall Street. Responsibility gets diluted. Everyone blames the system, but the system is made of humans. Michael Lewis raises a deep point here. When profit comes in invisible ways, guilt also becomes invisible. Money earned in microseconds is emotionless. No face, no voice, no victim is seen. And this is the reason that HFT became so big. Brad Katsuyama did not fit in this culture. He could have won the race for speed, but he refused to play. And this makes him different. Flash Boys does not say that Wall Street has changed. It says that Wall Street can be challenged. The market does not run on morality. The market runs on incentives. If the incentive is fairness, behavior will change. If the incentive is speed, there will be exploitation. This book shows that the real battle is not between machines and humans. The real battle is between values and profits. And this battle is still going on. Flash Boys is not the story of one man's victory. It is the story of that moment when the market was shown its real face for the first time. Brad Katsuyama did not defeat Wall Street. He just asked one question: is this really fair? And Wall Street was most afraid of this question. Michael Lewis makes it clear, the market does not become fair on its own. It is easy to make the market unfair, hard to make it fair, because fairness does not sell profit. Speed sells, complexity sells, confusion sells. Flash Boys shows that in modern markets, the greatest power is not information, but structure. Whoever built the structure won. Brad and IEX tried to change the structure. It didn't change completely, but it changed enough that ignorance is no longer possible. Now no one can say that HFT is harmless. Now no one can say that speed advantage is imaginary. Flash Boys does not teach us how to trade. It teaches us how to look at the market. It teaches that behind every price, there is a system. And behind every system, some kind of incentive. If you are an investor, then the biggest edge is not strategy. The biggest edge is awareness. The market is not what is seen on the screen. The market is what runs in the background. And this is the biggest message of Flash Boys. If you don't ask questions, then someone else will take the profit of your share. So this was the full story of Flash Boys by Michael Lewis. A book that doesn't tell you how to earn money, but tells you how money is earned from you. If you found this audiobook summary eye-opening, then like it, subscribe to the channel, and write in the comments. Do you think the market is really fair today? Because remember, the market remains silent but is never neutral.